Thank you for joining us for our CSA webinar, Greatest Risk in Retirement, Living Too Long. The Society of Certified Senior Advisors is pleased to welcome Ray Ferrara. Ray is the founder and executive chair of ProVise Management Group, LLC. ProVise is a nationally recognized financial planning firm based in Clearwater, Florida, is an SEC registered investment advisor, serves about 1,200 clients in over 30 states, and is managing about $1.6 billion as of December 31st, 2022. Ray taught the financial planning and estate planning classes to aspiring certified senior advisors for a decade. He also served on the CFP Board of Standards Board of Directors and was chair in 2014. He has been quoted in the Wall Street Journal, New York Times, Forbes, USA Today, Investor Daily, and many other publications. He hosted the radio show Talking Money for over 15 years. Ray lives in Bel Air, Florida, with his wonderful wife, Kim. Thank you for joining us, Ray.
And thank you, and good afternoon or good morning, depending upon where you might be. My pleasure to be with you and to visit with so many who are wanting to learn more about the issues around longevity, and particularly how they affect retirement. Do want to remind everybody, although Ann mentioned it at the beginning, that if you have any questions, just put them in the chat box, and hopefully we'll have some time at the end so that we can try to answer as many questions as possible. So there are lots of risks when in life and in retirement, not the least of which are inflation, which we weren't thinking too much about until about 18 months ago when it came roaring back, worse than it's ever been since the 70s. The stock market always presents risks, moving up and down. But as I like to describe it, it's like a man walking up a flight of stairs with a yo-yo. We have to take our eyes off of the yo-yo and realize that he's walking up the stairs. Taxes are a big issue. Are they going to be greater or lesser in the future? My guess is they'll probably be higher. Interest rate costs, healthcare costs, all rising and a threat to those that live for a long time. But the greatest fear is living too long, and particularly outliving one's money. So let's take a look at life expectancy. If we go back 1.25 centuries ago, 1900, person born in 1900 had life expectancy of only 48 years. Seems awfully short by today's standards, because by 2000, a person born in 2000 had a life expectancy of 78. When you look at the median in our population here in the United States, the median age in 1960 was 29.5 years, meaning half of the people in the United States were under that age and the other half were over that age. But as we have continued to see improvements in life expectancy and people are living longer, fast forward to 2023, and now that median is 38.8 years, with half above and half below. And in fact, just in the last 23 years, that the median has gone up 3.4 years. So our society is getting older because people are living a longer life, and a better longer life as we go along. Now, one of the interesting things is in doing financial planning, in the old days, we used to do the planning to 90, and then it changed to 95, and now we do it all to 100. And the most common refrain that I hear from clients is, well, I'll never live that long. People have a tendency to underestimate just how long they're going to live. The interesting part is, every year that you live, you actually increase your longevity. So when one ages, there is a year that's gone by, but it's not a 1-for-1. You don't lose a year. You actually will lose only a partial year. So the longer you live, the longer you're expected to live at any given time. And age is a very relative term. I have done this every year since I turned 50, and I'm about to turn 76 in a couple of weeks. So I'll update it again and I'll say, I remember when my dad was 76, and I'm darn glad I'm not that old. So you can imagine that life today at 76 for me is quite different than it was for my dad, and quite different for his as well. You know, people today are going to live in retirement 30, 40 years or more. In fact, there'll be a large cohort that will spend more years in retirement than they actually spent working. Contrast that with a generation or two ago. If you were lucky, you made it to 65, you retired, and 5, 6 years later, you were gone. So there wasn't a lot of planning that was needed. Today, it's very different, and it's only going to get longer in lifespans in the future as healthcare continues to get better, as we take better care of ourselves and we learn more about what the right things to do would be. Well, there's a lot of factors that are involved in one's life expectancy. Obviously, genetics is going to play a role. Money plays a role. What was your income during your life? What's your wealth? Which generally gives you better access to better insurance, better health care opportunities. We've all learned that exercise is really good for us, and many of us are actually doing it now. It's not something we said we were going to do starting tomorrow. We're actually starting it and doing it. Women live longer than men, although that gap has narrowed over the last half a century significantly. Education, do we smoke? Did we ever smoke? Have we abused or used drugs? All of these things come into play. And one of the things that you'll find in the paper is that, which we do with clients to help them understand how long they might be able to live, is there are a couple of websites that we've referred to in our paper that you can download that will help you determine for yourself what your own life expectancy might be, given a variety of factors. I have to admit, I'm just as guilty as everybody else to say I'm not going to live that long, because when I did this for the in preparation for this webinar, it says I'm going to make it to 104. We'll see whether that happens or not, but it does tell me that I will most likely live longer than both of my parents did, and Dad died at 93. Although I had an aunt at 96 and another one at 100, so I've got some of those good genes we talked about. Well, living too long is the second greatest fear. Dying too soon is the greatest fear. We all want to have a good life after we retire, and we want to live a long, fruitful, healthy lifestyle. And that's our greatest fear, is that we die too soon. But that second greatest fear is clearly living too long, and either our health catching up with us and the quality of our life declines, our money runs out. That is a great fear that many people have as they enter into retirement and older age. So as a financial planner, I have a couple of tough jobs. One of the first jobs is convincing people that it's okay to spend their money. It's a scary proposition if you've been working 40, 45, maybe even 50 years, as I have, to suddenly not have a paycheck. And where am I going to get the money to pay my bills? And so we have a tendency to want to kind of squander the money and keep it close to us, afraid to spend it. But it's okay to spend it as long as you're doing it within the bounds of what is a safe way to spend the money in the amount that you spend. Early on in retirement, there are those that have a tendency to spend a lot of money early, knowing that they won't need as much for some of those extracurricular activities later in life, and that's okay. You may as well enjoy it while you can. But at the other point that is a tough job is going to someone who hasn't been listening to you perhaps for a long time and tell them, hey, it's time to slow down. You can't keep spending at the rate that you're spending. You're going to run out of money. And the interesting part is that it's really rare that people will run out of money. Most people will cut back their lifestyle. In fact, when we do Monte Carlo analysis, which many people describe as what are the odds that you won't run out of money, we don't talk to our clients about it that way. We refer to it as what are the odds that you'll be able to continue your lifestyle, the one to which you become accustomed. And so people do run out of money. if they have to spend it on their health or on the health of one of their family members. But generally, it's about cutting back in your lifestyle. And heck, who wants to do that when you thought you were going to have a good, long, happy retirement? So as a result of living longer, we're going to need funds for a longer period of time. That makes obvious sense. And the amount that we need to save is not only going to be greater because we're going to live longer, but because of other factors like inflation. Many of us are going to work past age 65. Some of us are going to do that because we have to, because we didn't do a good job saving early on. But many cohorts of retirees are going to continue to work because they love what they do. Take me as an example. They hope that they're continuing to add value to whatever work they're doing to the people that they're serving. And many of us, particularly those of us that are entrepreneurs, it's our life. And what would we do without that self-identity? So people are going to continue to lengthen their time working as a result of knowing that they're going to live longer, and again, because many of them are going to have to do it. The government has even recognized this. In 1974, Congress passed the first bill regarding individual retirement accounts and IRAs. And in that, they said, you can accumulate all this money for retirement, but we want to eventually tax you. So beginning at age 70 and a half, you're going to have to start paying us money. Well, with the CARES Act, they moved that up to age 72. And with this most recent piece of legislation from late last year, it'll move up to 75 in 10 more years. So right now, it's age 73. So they want you to keep the money there longer to allow it to accumulate and not to dissipate it too soon, knowing that you may be living a much longer life than you anticipate. So what kind of income do you need when you head into retirement? Well, most people would tell us, I want as much as I'm making when I retire. So let's take our imaginary couple who's making $100,000 between them, and they're saying they want $100,000 to maintain their lifestyle. But in order to maintain their lifestyle, they really don't need $100,000. They may want it, but they really don't need it, because you see, while they were working, they were paying about $7,600 in Social Security and Medicare taxes, and each of them were putting $5,000 a year into their 401k. So that at the end of the day, they've really been living on $82,000. And so that's the money that's been supporting their lifestyle, and that's the goal that we have in working with folks. Now, if they can make more, that's great, nothing wrong with that. But in terms of trying to meet a plan to maintain their current lifestyle, we're going to shoot for that $82,000. Well, when we do that, first thing we're going to do is look at Social Security. And again, by the way, I've given you some websites to go to, including Social Security, that'll allow you to determine for any client what some of the better options are to continue. The area of Social Security is extremely complicated. You can't use a cookie cutter approach to it when you're working with clients. So take advantage of using some of the software. Now, today, full retirement age is 67. And that's where you get your full benefit that's been projected for you by Social Security. Some people will want to take it earlier than that. And when you take it earlier, there's a penalty for that. In fact, if you take it as early as you can at age 62, your benefit will decline by 30%. So if your benefit was $2,000 a month at 67, your benefit in this particular case would be 70% of that, or about $1,400. There's a second problem taking it before your full retirement age, and that is the amount of money that you earn. Not the money that you make from investments, but the amount of money that you earn from working. If it exceeds $21,240, for every $2 over that, you have to give back $1 of Social Security. And it stays that way until you reach age 67 at full retirement age. Then you can earn as much as you want. So there's two penalties for taking that money early. The first is you're limited to the amount that you can earn in wages, and your benefit is reduced, and it's permanently reduced for the rest of your life. If you have the ability to wait until age 70, which is where the maximum benefit today exists, then you'll get 8% more in your benefit for the next 3 years. So again, if you take our $2,000 example that we just had before, it would add about $1,600 compounded over a 3-year period of time. So it would add about $6,000 to the benefit. Social Security is under a lot of pressure. It says they're going to run out of money sometime in the early 2030s. Congress is going to have to figure something out. We'll talk about this more in a little while, but when they did Social Security, it's all based on life expectancy. Life expectancy is greater now than it was under some of the old formulas that they were using. And as a result, with people living longer, it's putting more and more pressure on the system, particularly when you combine that with the number of people who are working today to support those that are in retirement and taking Social Security is getting smaller and smaller. So should you take it early? Well, the short answer is yes, but as is often the case, yes, you should if you need it. If you're retiring and you absolutely need that additional income, even though it's reduced, you still have to get from 62 to next year. So that's obviously a time to take it early. For someone who's in poor health, that may not make it to 67 or may not make it to too many years past that time because of health concerns that they have, that would also make sense. And for those where you have spouses and one spouse has a significantly higher benefit than the other, then it may make sense for the one spouse to take it at age 62 or below age 67, because at the end of the day, whoever the surviving spouse is, they will get their benefit or their spouse's benefit, whichever is larger. So again, if there's a big difference between the two, it may make sense to take Social Security early. So let's take a look at what does it take to get the rest of the income we need. Well, if we need $82,000 and our couple is going to get $42,000 in Social Security benefits, then they're going to need an additional $40,000 of cash flow or of income. Well, where is that going to come from? It's going to have to come from savings and investments. And in this particular case, it comes out conveniently to just about $1 million. Using the 4% rule that many financial planners use, saying you can draw down 4% of your investments and continue to have it grow and hopefully adjust for inflation going forward. So the $1 million is our target. Excuse me. So what does it take to get there? Well, it isn't easy, but you can get there. Right now, it would require you to have $5,000 invested a year for 43 years at a 6% rate of return, and you'd have $1 million at, let's say, age 65. But there's this silly little thing called inflation, and using an average over the last 30 or 40 years, we're going to say it's 2.5%. You need to think about going into the future. If you're only 22 today, excuse me, you got to adjust for that. So get the equivalent of $1 million. You need actually $3.6 million 43 years into the future, which means you'd have to start saving $18,000 today. So it can be done. And obviously you're going to start smaller than the 18,000, and in later years, hopefully you'll be putting in more than that. But it isn't easy. And let's look at how easy it is not. Because only 10% actually ever get to $1 million as they go into retirement. And this is where that fear part comes in, and the risk of longevity becomes so important, because the average person today only has $220,000, according to Fidelity, saved towards their retirement. And worse than that, the median is only $164,000. So think about our couple who lived a very good life for a long period of time. Had they not saved properly and enough, it's not going to last very long in retirement. And that's where the fear part comes in of outliving your money and living too long. So let's look at inflation for our retired couple, because they start out needing $40,000 a year, but in 10 years to have the same purchasing power, they need $51,000, and in 20 years, $66,000, and in 30 years, they need more than double what they needed to start with at $84,000. So inflation obviously is something that eats into our purchasing power and has to be dealt with over that period of time. And you don't have your wages going up anymore like you did when you were working and inflation was affecting your lifestyle. You could get a raise. Where's that raise going to come from? It's going to have to come from your savings and your investments, earning more than whatever the rate of inflation is, plus whatever you're withdrawing. So what's the first step you have to take in trying to figure out, am I going to be okay? Well, you start with those two basic documents, the first of which is the net worth statement. You want it to look at the assets that people have and the liabilities that they have, and you create the net worth. You need to look at the assets from a standpoint of how are they invested, where are they invested, are they properly invested, are they going to give the kind of cash flow that is needed? What about any liabilities? Are there any liabilities that can be eliminated as you go into retirement? And while it's ideal that you have no debt, the reality of it is most of us do when we go into retirement. The next thing you do is you look at the cash flow statement, and that's the budget. You know, that really boring thing that nobody likes to do. The budget has your income on one side and your expenses on the other side. And the way we like to do budgeting with clients is to divide the expenses into the must-haves and the like-to-haves. And the must-haves are the things that we have to pay every month. We've got to buy food. We've got to pay for the utilities. Maybe we've got to pay for a mortgage. We've got to pay for a certain amount of entertainment for the internet, cable, etc. So those are must-haves. And then the like-to-haves are, well, we like to go out to dinner, or we like to go out twice a week. We want to go on a vacation or two every year. We want to belong to a country club. Those are like-to-haves, not must-haves. And what we like to do to help people to not run out of money is to set up their financial plan where the must-haves are covered by essentially guaranteed income that would come from something like Social Security, as an example, and or a pension, and the like-to-haves come from the savings, from the variable amounts that can be adjusted from one year to the next. If we had experienced a year like we did in the market in 2022, we'd cut back a little bit on what we're spending in 2023. And in fact, that's exactly what we're seeing happen today with the American consumer. So how can you cut costs? What are the things that you could do to cut the costs? Well, one of the biggest costs are going to be that now you're going to be paying for your health care. It's not going to be provided by your employer. And you have to make a choice between Medicare and Medicare Advantage. Medicare is the government program since the mid-60s, designed to take care of those that are disabled and retired. But over the last couple of decades, there's been an alternative plan called Medicare Advantage. With Medicare, you have copays, you have deductibles. It doesn't cover everything, so many people buy a supplement to cover those things that Medicare doesn't. Where with Medicare Advantage, you still have to pay the premium that you would for your base amount for Medicare, but it's unlikely that you're going to need a supplemental policy. It could cost a couple $1,000s a year because all of that's going to be covered under the Medicare Advantage plan. In fact, they've become so popular that today, 48% of all the people who are eligible for Medicare are on a Medicare Advantage plan, not on traditional Medicare. Not only does it not cost as much, but it'll actually cover some things for eyes and dental, and some plans will even pay cash back to the recipient. Sounds like a really good deal, but the trade-off is that you may be limited to the doctors that you can see, and unlike Medicare, where if you get a referral from your doctor to have something done, you're able to go. In a managed care plan, you may have to get permission in advance. Another place to look to cut some costs are if they still have a mortgage. And appreciate the fact that anybody who itemizes their taxes today probably financially is better off keeping the mortgage in retirement than they are to pay it off. But a lot of people just don't want that monthly payment anymore. And even though financially it may not be the best thing to do, if it's something that they feel is important to them, you've got to accept that and recognize it and let them eliminate that particular cost. The trade-off, of course, is you reduce the amount that you have in your savings and investments. Another area to try to cut costs, and I'm sure many of you are working with your clients today by trying to cut their tax bill. What are the different ways that you can cut down on the amount that they have to pay in taxes? For instance, Social Security. Ever since the mid-90s, Social Security has become taxable. The thresholds that exist there haven't been increased over the intervening 30-some years. And so more and more people are finding their Social Security to become taxable. Some of the things that you can do to perhaps cut down on taxes going into the future is to look at doing Roth conversions with their traditional IRAs. The important aspect here is that if you do a Roth conversion from a traditional to a Roth, moving it from tax deferred to tax free in the future, is that you have to move 100% of the money. That means pay the taxes on the IRA money from some other source. Yes, you're going to reduce your savings by that amount, but now the money that's in that Roth IRA is going to grow tax-free for you to mix in the future with tax-deferred money, tax-free money from the Roth and perhaps other investments, as well as whatever earnings a person may have. Using an annuity is another way to help spread the tax burden out over a long period of time, because when you give an insurance company a lump sum of money and they start paying you back monthly, part of it's interest and part of it's principal. So even though it feels like you're getting 100% of income, not all of it is going to be taxable. Although not used early in retirement, but later in retirement, setting up a reverse mortgage also is another way to create cash flow without increasing the tax burden. And ultimately, having a well-diversified portfolio that is well managed, taking advantage of limiting capital gains as much as you possibly you can. We all want to make money, but we want to do it in a tax-efficient way, if at all possible. So that's kind of some of the financial side. What about the social and personal implications? Well, if you look at the bottom of the chart, time. All of a sudden, you've got time. You've got time to take care of new interests, new hobbies, whether it's photography, painting, anything else in the arts, collecting stamps, whatever it may be. You'll have new interest and time to actually do it and enjoy it. Obviously, a lot of people are going to want to travel. Some people, however, are going to continue to work either full-time or part-time, but as we describe it, retirement is not a time in life or an age in life. It's when work becomes optional. And if you're continuing to work because you want to, you have a whole different attitude about how you look at work. But some people are actually going to go back to work and go into a new profession and do something entirely different than what they did in their entire career going forward. And lastly, with that extra time, an opportunity to find where your passion lies in not-for-profit work, and to volunteer to the many organizations that need help. It's interesting, one of the things around studying longevity is that scientists have discovered what they have now called blue zones. And these are places where people have lived an unusually long life, a whole populace has. And these are 5 places that are listed here. Greece, Japan, Sardinia, Costa Rica, one place, Loma Linda in California. And these cohorts are being studied significantly and followed closely by scientists as they're trying to understand why these folks are able as a group to live longer lives than much of the rest of society. So early on, move to one of those places, perhaps, if you can afford to do so. There are lots of issues that come about as a result of people living longer. Not the least of which is that our normal, what we have perceived in the past as our normal lifespan, is changing and changing dramatically. It is not just a function of people dying when they're supposed to, and people being born to replace them. With us living longer, we are becoming more populated faster than most thought we might. And so one of the first things we have to concern ourselves with is our sources of food. We are going to need more food for a longer period of time, and it's going to become more expensive. Demand goes up, supply can't keep up with it, prices go up on food. With more people living and more people consuming things and doing things, we're going to contribute to more global warming than we might have otherwise had people not continue to live well into the future. And so longevity will create more global warming to occur. And tied in quickly with that is pollution. It means we'll drive more for a longer period of time. It means we'll need more demands for energy, all of which will contribute to pollution in the world. And interestingly enough, in those societies that age, where people have lived for a long time, birth rates have a tendency to go down. And if you look at Japan as a great example, we have been watching that occur for the last 30 years as they have aged and their birth rate has gone down, and we've seen their economy stagnate since the late 80s as a result of it. And the question is will we be facing those same kind of issues and those same kind of problems as we go forward, or will we be able to find some solutions that have not yet been discovered? But something for all of us to be thinking about and be concerned about. So some other issues for us to look at. It means we have a smaller labor pool if birth rates are going down, particularly the number of people who are working to support those that are older in generations. We have people who are not working anymore, not being, if you'll pardon the expression, they're not being productive at an economic sense. Productivity goes down. That means inflation goes up. That means economic stagnation. Although if you listen to the folks over the last couple of months, we don't have to worry about that because artificial intelligence is going to figure it all out for us. Obviously, my tongue is firmly planted in my cheek as I say that. We're going to face problems with inflation that we didn't perhaps anticipate because when you have decreased productivity, generally expenses actually go up. Many countries may turn, and us in particular, may turn to solve some of these problems to immigration. And I'm talking about legal immigration, not illegal immigration. That if you are not going to birth within your own population a younger cohort, maybe you allow that group to immigrate into the country to fill those jobs and to fill some of that vacuum that's been created. But of course, there's all kinds of social issues around that as well. And we've seen that our Congresses for over a number of years haven't really been able to figure out a way to solve that problem at a social and political level. And because people are living longer, they're going to have decreased savings. And decreased savings means there's less capital available for investment, from banks to loan money, or for people to buy stocks or buy bonds. And so with lower capital, it could have an economic impact that needs to be addressed as well. So one of the things that a family level are going to have lots of issues. They'll 5 generations alive at one time will become common. I happen to have a picture from 1947 when I was born of myself, my mom, my grandmother, my great-grandmother, and my great-great-grandmother. But in 1947, 5 generations was a very rare thing. Today, it could be a very real thing. And that means that it's not just a function of the kids supporting their parents. The kids who are getting ready to retire may be forced to look at helping not only parents, but grandparents at the same time. So putting pressure on those family structures. On the positive side, that big spread of generations will allow a lot of that intellectual knowledge and family issues to be passed down from one generation to the other, so that perhaps we are able to learn from those that were alive 100 years ago and understand what they have been through and what they've experienced in their lifetime and learn from it. And then if I'm going to live longer and I want to do more things, and if I've got good health, I'm going to spend more money, which means the inheritance that the kids are going to get is going to be reduced and it's going to be delayed. And so those who have been counting on their parents dying and passing on money to them so that they could fund their own retirement may find that they may be well into their retirement before any money is passed down. My wife and I were not blessed with any children, so our heirs are nieces and nephews. And our philosophy has been, either we're going to go first class or the nieces and nephews are, and we vote for us. So, there'll be less there than there might have been had we not been willing to have spent it and knowing that it'll be done over a longer period of time. Financial issues to talk some more about. When we look at pension plans, Social Security, and annuities, all of these are based on life expectancy assumptions. And the pension plans that are in existence today, many of them are still looking at old issues of longevity, meaning people living into their 80s, and haven't really addressed the issue of people living into their 90s or to age 100. The same is true with Social Security and with annuities, because if insurance companies are going to pay somebody for their entire lifetime, and they've assumed that they're only going to live to 85, but they end up living to 95 or 100 or more, the insurance company is going to have to continue to pay out. And if their actuarial assumptions are wrong, it means all of these 3 items are going to be in significant trouble. Life insurance, however, on the other hand, should become cheaper because people are going to live longer, and therefore they don't have to charge as much. Long-term care insurance is going to become even more important because more people are going to live long enough actually need to go into a long-term care facility. And then we have to deal with age discrimination, and we don't have to look any further than the White House to see age discrimination in place. A lot of conversation going on right now about the president being reelected at age 82 and being 86 when he leaves office. How can anybody who's 86 really be president of the United States? People are asking. I don't know, but when I get to 86, I hope I still have some mental acuity that would make it okay for me to be able to do that. It's kind of the old mindset. There are mandatory retirement ages. Think pilots, think judges, think board members. It's a subtle form of age discrimination and age bias. Maybe you want to go back to work and you apply for this job you'd really like to do and have fun with it and everything else. Oh no, I'm sorry, you have too much experience for this job. Again, another subtle way of saying you're too old. It's harder to borrow money and to get credit the older you become. And the fraudsters that are out there scamming people are trying to take advantage of older folks. And unfortunately, they're being more and more successful and more clever. So age discrimination, age bias also will increase as people live longer. When it comes to lifestyle issues, we all want to stay in our home until we can't stay there anymore. It becomes too expensive, it's just too much of a burden, whatever it may be. So assisted living facilities should be a growing business into the future, particularly as the baby boomers are moving in that direction over the next couple of decades. Some are going to be forced to move and move not just out of their home to perhaps to a totally new location because they need to be closer to family, perhaps. And all of these changes, particularly as we age, are disruptive, and they're going to lead to more mental health issues and depression for many who are living longer. And so, in conclusion, let me simply say that there are lots of issues that are being presented as a result of people living longer. You are in a perfect position as CSAs to help people understand these issues, help them to address these issues, and to give them a greater sense of security as we go into the future. With that, I'd be happy to answer any questions and want to thank you very much for listening to the presentation. Anne?
Thank you, Ray. We will now begin the Q&A portion of the webinar. So if you have any questions at this time, please share them with us through the questions panel on the right-hand side of your screen. In addition, I want to mention that if you are interested in being added to Ray's email list, you can also add your name and email into the questions panel. We'll make sure that that happens.
You can do that, or you can send an email to eps@provise.com, and we'll be sure to do that. The perspectives are a newsletter we do every 2 weeks to our clients and friends on thoughts of what's going on in the economy, taxes, Congress, all of the things that affect people in their financial planning.
Great. Okay. I will now start the questions. First question, do you think we will continue to use the term retirement?
In many ways, I hope not. I've often thought of writing a book that would, and the title of that book would be Don't Retire, Rewire. And I think so people will go into rewirement, particularly those of us that are healthy. And retirement will become an ancient term at some time into the future.
Next question. Is there a difference in retirement experience for those older adults who are immigrants?
Wow, a really interesting question. I hadn't really thought about it. I guess whatever the social issues are that might come with someone who has immigrated, I imagine that carries over into the retirement the phase of their life. An interesting thing is going on right now, and people aren't paying a lot of attention to it, unfortunately. Back, I'm going to say 10, 15 years ago, there were a lot of folks from China that came over here to be educated and then went back to China because the opportunities there were so fantastic. But now there is a trend for those same students that are coming over and people who are coming in under the other visas to permanently want to stay here and not go back to China. But just the opposite is occurring with those that are of Indian descent. Again, many of the Indian folks came to America, got an education, and they stayed here. But now, many of them are starting to go back. So I guess the difference would be is where do you want to spend the rest of your life? Is it continue to stay here, continue to move back to your home country? So I imagine that's more a personal issue than it is anything else.
Next question. You mentioned the 4% rule. Are you comfortable with that percentage, or do you think that should be modified?
I think that the 4% rule is not a rule. I think it's a guideline. Obviously, if you don't need the whole 4%, it doesn't mean you have to draw it down. It also makes a difference as to in the timing of when you start your retirement. And so what we do in working with our clients is I call it a guideline. That's all it is. And we kind of have bumpers on both sides of the road. And if we have a tough year like we did in 2022, and talk to people coming into 2023 about, well, maybe on those variable expenses that I talked about earlier, maybe we can cut back just a little bit this year, take one less vacation. You know, don't bring the whole family together this year, whatever it is to cut, you know, to cut back. On the other side of that is that if we have one of those good years like we had in 21, maybe we can spend a little more than the 4%. Now that doesn't mean you spend all of what you gained or you cut back all of what you've lost, but you kind of put some bumpers around it. And again, I like to refer to it as the 4% guideline, not a 4% principle.
Great. Question about what you were talking about when the spouses have a large income difference. Is that if the higher wage earner is younger or older, or how do you take all of that into account, the age differences?
So as I said, Social Security is a very complicated situation. You have to look at not only the age difference between the spouses and the income differences between the spouses, but what if it's somebody who has married somebody who is significantly younger and maybe they have children? You have to take some of that into account as to the involvement with Social Security. What will be the benefits if the older spouse dies to the surviving spouse and to potentially to surviving children? So that's why I encourage people to use the software so that you can do a lot of what if planning and let it help you, guide you to what's the best alternative in any situation. And again, it's a guide. It's not, you know, it's not the be all to end all. It's simply a guide.
Okay. Do you have any advice for SRES or similar senior services professionals regarding being a resource to your clients without looking like you're marketing?
I'm not sure I understand the question. So I'm going to do the best I can. First of all, I don't think there's anything wrong with marketing. We all are selling ourselves in many aspects of our life as we go along. It's when you do it the wrong way that I think it moves over the line and can become uncomfortable for the person doing it, and even more uncomfortable for the person that's receiving it. But if you're talking about someone like yourself to become a resource to us, we use a lot of folks as resources. At ProVise, we have an expression: what we do well, we do very well, and what we don't do very well, we don't do at all. And so we rely on lots of other people to help fill in the gaps. I mean, a perfect example is I do not know that much about the ranking of assisted living facilities or perhaps even nursing homes. And so we have folks that's their livelihood, that's what they do, and they've marketed with us, we market with them to help them in financial situations, to give advice to clients, and helping each other is what this life is all about. So I'm not sure that it addressed your question, but I hope I got close to what you were asking.
In your opinion, do you think that most financial services professionals understand all of these life expectancy issues?
Unfortunately not. Most financial planners, when they're writing financial plans, are going to do at least a 95, but they, like all of the rest of us, well, they're not going to really live that long. That's kind of the expectation. And it is a serious issue. It is an evolving issue that is becoming more apparent to more people and really being addressed by a lot more planners in a much more proactive way than we as a profession have done in the past.
Okay, there are a number of questions about sites you recommend. I think you mentioned that you have some in your handout that will help determine life expectancy, or free tools online where you can enter your sources of income, age, and get estimates.
Yes, if you'll download the paper that I wrote, I've got the websites in there, and they should be blue lines. So hopefully you just have to click on them and it'll take you right to the site. And there, by the way, it's interesting and it's fun. And one of the things that you can do for yourself and for clients is change the factors that you're able to change, to see what the effect would be on your longevity or not.
Okay, last question. How do financial planners take into account the potential need for long-term care? You talked about how people want to maintain their lifestyle. How does the potential need for paying for care in the future, how is that taken into account?
So a lot of people who need to have a long-term care policy, unfortunately, aren't able to afford it. And that's the great dilemma that exists. And a lot of the people who can afford it don't really need to buy it because they have sufficient assets. There's a couple of different things that people can consider doing. In an indemnity type of policy, which is you pay the premium, and if you never go into a long-term care facility or never need home health care, it's like you paid for your automobile insurance and never had an accident. And it's expensive. It's not inexpensive at all, as I'm sure you know. But some new products have come out over the last 10 or 15 years, both life insurance policies where you can make a single payment and have the life insurance available to be prepaid, if you will, should you go into a long-term care facility. Also some annuities that have been developed that will allow you to take some withdrawals in the case that you go in. So there's a variety of products that get you there. But as I said at the beginning, the unfortunate part is that so many of the people who are going to need it at some point in the future simply are not going to be able to afford it. I want to thank everybody. Thank you. Thank CSA. I've enjoyed my some 30-year affiliation with the organization. Thank you to all of you. Please sign up for the prospectus. I promise nobody will be soliciting you. It's just our way of giving to you. I hope you enjoy the read. And if there's anything I can do to help any of you, please don't hesitate to reach out. Thank you and have a great day.
Thank you, Ray, for an excellent presentation. On behalf of all CSAs and attendees, I'd like to express our appreciation for you taking the time to provide us with this valuable information. Thank you for taking part in the Society of Certified Senior Advisors presentation of the CSA monthly webinar series. We hope you enjoyed it, and we invite you to please join us again next time. Thank you.